To those who are new, welcome, and to those who are returning, welcome back to the channel that simplifies the stock market. Now, in this video, we're going to be going over profit margin, and we're going to be discussing why you should pay attention to profit margin and why it's such an important factor to look at when you're looking to invest and put your money into a company within the stock market. So, without further ado, let's dive on into it. Okay, so a company's profit margin can be calculated using this formula: the net income divided by the total revenue. Now, you can think about it like this. If I run a lemonade stand, for every dollar of lemonade that I sell, how much of that do I actually get to keep as profit? And how much is lost to my expenses, such as taxes or paying employees, paying for the lemon, the water, whatever the case may be. So this is an important idea to wrap your mind around and pay attention to when you're looking for companies to invest in. Now, let's say we have another t-shirt company within the stock market. And again, this company gets its revenues from selling t-shirts, right? So let's say that last year they sold $100,000 worth of t-shirts, right? And then over the course of the year, they had expenses, of course. It takes money to make money. They had to pay their employees, they had to pay taxes, they had to pay the fabric manufacturers, or whatever the case may be, and these expenses amounted out to $60,000. So you can see that $100,000 of revenue minus $60,000 equals $40,000 net income. All right, now you calculate the company's profit margin by taking this $40,000, you divide it by 100,000. Again, the net income divided by the total number of revenue, or the total revenue, profit margin, and this equals 0.4. Now this is in decimal form, so in order to get it into percentage form, you just multiply it by 100, and that gives you 40%. So this company has a 40% profit margin. Now this is great, right? This is not common in the stock market. This is actually very great to see. If you see a company with these kind of profit margins, yeah, I mean, likely everyone is flocking towards it. But you can see that 40,000 is 40% of 100,000. And again, you can think about it like, okay, this company has this sort of cushion towards not being unprofitable. So if the business actually has a downturn, if you think about our current economic environment, right, we're actually going through a pandemic, coronavirus. So let's say that this company has gone through coronavirus and the demand for their t-shirts has actually dropped some, right? So instead of this next year, them selling $100,000 worth of t-shirts, they only sell, let's say, $70,000 worth of t-shirts, right? And you can see the drop in the revenues, and let's say that the expenses stay relatively flat. They might be able to cut these a little bit, but for example, let's say that they remain relatively flat. And now this number changes from, so this number changes from, it was 40,000 and now it's 10,000, excuse me. Now, these of course will change as well. This will be 10,000 for your net income. This will be 70,000, and then these numbers will change. And then, just off the top of my head, this will be 10 to 15%. And you see that the profit margin before was 40%, and now it's 10 to 15%. You can use your calculator to check my math on that. But now you see that the company's profitability has dropped off some, but the company is still profitable, right? In a downturn in business, they actually still were able to turn a profit. So this is a good sign, right? Now let's consider the flip side of this. Okay, now for this flip side example, we're going to compare apples to apples and say we have another t-shirt company within the stock market. And let's say that this t-shirt company also had $100,000 worth of revenue, so they sold $100,000 worth of t-shirts. But this company had $95,000 worth of expenses, right? So you take 100,000, subtract out 95,000 of expenses, and you get 5,000 of net income. Right, so you can calculate this out. You can pause the video and calculate this out, but 5,000 is 5% of 100,000. So they have a profit margin of 5%. But let's say that this company also, last year they were able to do this, but this company also faces the same pandemic, the same coronavirus. And instead of $100,000 of revenue or t-shirts that they were able to sell last year, they're actually only able to sell 70,000 worth of t-shirts. And this number changes from a profit of $5,000 to a loss of $25,000. So when you're looking at companies to invest in the stock market, you want to be mindful that if a company has a very narrow profit margin, like 5%, 3%, or whatever the case may be, if there are downturns in the business, which downturns you have to be prepared for, mentally prepared for, financially prepared for. This company is at risk of becoming unprofitable for however long that stretch is, which could be a risk to the company that you're actually part owner of or investor in. Now, when you have a loss or this is negative, then you don't calculate the profit margin. It's just, you just have a loss. But that's profit margin. Okay, now to close out this video, let's look at a real example from a real company within the stock market. And we are looking at American Airlines. Now, first off, you could see American Airlines revenue from last year, and we're just going to say that this is before the pandemic hit, coronavirus hit. We're going to calculate the profit margin from last year. And this is just on Yahoo Finance. You go to financials, the income statement is where you can see a company's revenues, expenses, and net income. So let's calculate it out for 2019. And the net income was 1,686 million. You divide that by its total revenue number, 45,768 million. And then that gives you 0.036, but then you multiply it by 100 to get the percentage, and you can see that they had very narrow profit margins, 3.6%. Now again, we go through the pandemic with the coronavirus, and you see that demand has fallen for flights. Again, not a lot of people are flying, so of course reduces ticket sales and all the revenues that American Airlines can get through flights and through their business. So you can actually see that their revenues have been cut drastically in the last 12 months, almost half. So because of this, whereas before they were profitable, now they're actually generating a loss or operating at a loss. So you can just see how the narrow profit margins, if they had a higher profit margin and their costs weren't so high, then they could possibly still come out this period unscathed or, still profitable. But just to tie it into the stock price, you can go back here and you can see for the year to date, so the last, since January 1st of last year, you can just see how their stock price performed over the year, that the virus hit. So this is just an important thing to look at, or an important factor to look at, that when the company lost profit or was unprofitable and operated at a loss, their stock price suffered, right? It went down. So it hasn't gone back to the levels that it was before it took this big drop last year. And, in the future, if they start to turn a profit again, I'm sure that this stock price will rebound. But just for now, again, it's just something to pay attention to when you're looking at a company and a company's profit margin and investing in companies with great room in their profit margin just for downturns in the business. But wait, there's more. It's not a set in stone rule, but I generally don't like to invest in companies that have a less than 10% profit margin. Now, when you're looking for companies to invest in, you want to compare apples to apples and pick companies that are within the same industry. But when you look at, for example, an Apple that has a 25% profit margin, There's definitely no way that I'm investing into a similar tech company that has less than 5% profit margin. It's just not happening.